Hello everyone, this is Professor Kent, and today we are going to talk about chapter 3, which is volume 1, measurement. In this chapter, we're going to be learning about the evaluation and techniques to measure the financial statements elements and how to use IFRS 13 to measure the fair value and how to apply the present value concept to measuring the financial elements. Um, just going forward with this chapter, the first topic that we're going to be talking about is the measuring financial statement elements. What are some of the elements we have learned about? Some of the elements are, for example, the assets and the revenue. In this case, those are the ones that we are kind of looking at it: assets, liabilities, revenue, equity. Those are some of the elements of financial statements, but in this case, in this chapter, we're more looking at a revenue, from the revenue and assets, at least more of an asset than the revenue. We're going to in this measuring chapter, we're going to know how we measure financial statement elements significantly affect the income and the key ratios. Then sometimes the measurement is required at the time the initial event happens or the initial transaction happens, and sometimes the measurement is required when we are doing a subsequent valuation, maybe later on at the end of the year we're doing an evaluation, and that's when we do the measurement. There are different measurement models that are available, and we're going to be discussing all of them, and we're going to be using some of the measuring tools in this chapter. There's the first one first model that comes into the author is talking about is historical cost and the current value model. Those are the two that we used when we talk about assets. So combination of cost based model and current value, for example, fair value measurement model. So those are the two that are used when we talk about assets. So those are the two that are used when we are talking about assets. Now, when we talk about a cost-based model, that is for the long-term assets, property, plant, and equipment, carried at a cost or a book value, and then it's recorded at a historical cost. So that's what it means is a cost-based model. The assets are recorded at the cost. And some of the financial instrument, when the financial instrument can be carried at the cost or an amortization cost. But if you have the financial instrument that you have the investment, you're going to be selling it later on, then you'll be carrying it at a fair value. So if it's a financial instrument that you're using it, you're not there. This investment or instrument is not there to resell. It carried at the cost, and sometimes if it's a carried at the cost, then we amortize it, and when we amortize it through method of amortizing that, using an effective method or a straight line method, depending on if the company is following an ASPE standards, they will be using a straight line method to amortize it. But if they're using a IFRS, they will be using effective method to amortized. Now the inventory, we're going to talk about it later using various as cost model. We're going to talk about it as a lower of a cost or a net realized value. Those are the only two that can be used for the inventory when we're measuring it. Some of the assets can be measured at the current value. What are some of them? Financial instrument or slash instrument slash investment, like when we talk about fair value net income investment or fair value OCI investments, those are recorded at the fair value. And then some of the investments properties, they're also recorded they're also measured at the fair value. Going further with the measurement categorization, hybrid measures. Now, when we have a property on plant and equipment, they measure measured at the recoverable amount. So now they're impaired. So what we need to do it at the end of the year when we're producing our financial statement, we needed to compare our value with the market value or recoverable value, and from there we needed to test it. Are they impaired? If they're impaired, we need to do an adjusting entry. Now, when you're then like I said before, inventory measured at a lower of a cost and a net realized value. So these are the two methods of measuring the inventory: lower of a cost and net realized value. Now the next one is impaired notes receivable measured using management's best estimates. So when we're talking about any type of receivable, then what they do is management uses the estimates. When they use the estimates, from there we measure the notes receivable, and we find out if they're impaired or not. If they're impaired, we need to do an adjustment at the end of the year. Like we talked about in the previous chapters, disclosures are very important. They are no disclosures are extremely important because of the judgment. Sometimes what we use is just like a notes receivable, we use estimates. When we do use estimates, it is important to find out where we got the estimates, because there's uncertainty. We don't want any uncertainty in our financial information. So note disclosure is important, because we needed to let our audience know what type of estimate did we use, where the information came from. And sometimes in our assumptions we have uncertainty. We're not sure what we predicted that the cash flow is going to be 1,000 per day. It wasn't 1,000. So there's sometimes an uncertainty when we are measuring some of the assets, when we're using the future cash flow measures. There's three techniques that we need to work on, that we are going to be doing. We're going to be using calculator to use these models. There are various techniques for measuring values. There's three models that we're going to be learning: income model, market model, and a cost model. So when we think about an income model, when we calculate, what we use is when we're using income model, we use present value calculations, and we also use cash flows when we're calculating the income model. When we think of a market model, this model is available in the market, so uses publicly available values from similar market transactions. So what we look at it, we don't estimate anything. Whatever the information that we have it available, the value that we have it available in the market, that's what we use. That's why it's called a market model. When we think of a cost model, reflects the amount required to replace an asset. So if you have an asset, if in other words, cost model it reflects the amount required to replace it. If you have an asset and that something happens to that asset and you have to replace it, the amount that you have to pay to replace that asset goes under the cost model. So of course, any model we use, there's a three components of it. There's an input, and then from there we do use different models, and then we have an output. The quality of the the output. So for example, output depends on the input. So how much, it's just like think about it, think in your studies, the input is how much time you're spending, how you're studying, which model you're using to study. You're using Wiley Plus, you're using doing the homework, and your output will be your marks. So whatever you put it in, that's what you're going to get out. If you put in a lot of time studying, of course you're going to get good grades. I'm not saying that some people are the other way around too, so I'm not saying that, but most theory behind inputs and outputs is the quality of the measure of an output depends on the information that we have it available. So if you're not putting in any time, there may be output will be not so good. When measuring the value of financial statement elements, an accountant must ask. As an accountant, you must ask these questions before you could do the valuation techniques. So which model of technique should be used. So maybe income model is more appropriate for a different situation, market model is more appropriate, or a cost model is more appropriate. Now, which input should be used? Should we use an interest rate? Should we use what should we use? What input should be used? And then from there, once we have the input and once we have the model, then the results the output that comes out of the input and the model will be very results in a useful information. Now, this is just saying which, of course, every situation is different depending on the information that we have it. We decide on the model, so not a specific model for specific situation. So depending on the what we want in the output and what the input we have it available, and that's what we use. That's what we decide on that specific model. Now, when we think about an input, what are some of the inputs and assumptions that are made reliable? The inputs that you put it in has to be reliable, and the amount, sometimes we use the amounts that are readily available to us, and we're not estimating anything. These information is available to us. Sometimes we estimate the cash flow. So if you don't have reliable, in other words, when we estimate it is more reliable, estimate of a cash flow may require assumptions on how this asset is going to be used. Sometimes we use the time value. Our input base will be time value of money, and sometimes when we have an input for income-based models, may include some kind of uncertainty. So now sometimes when we're using an income-based model, so when we're using an income-based models, these are some of the assumptions we can make when we're using an income-based model. It means we're going to be receiving income later on. In this case, if you invest money, you'll be receiving interest. Interest rate plays a role. Your input will be interest rate. Your input in the income tax model could be a cash flow, could be sometimes uncertainty. May uncertainty or rate or risk mitigate by adjusting either the cash flow or the interest rate, applying the probability. Sometimes we know for sure, we estimated but the cash flow, but those cash flows are not 100%. If they're not 100%, if we're given, we can maybe range it that the probability of that cash flow will be this. Then we have to take probability into consideration when we're talking about our inputs. Now, resulting in quality measurement should provide useful information. So when you have an output measurement should be useful information to the user, so it should make a difference. Must be relevant, like we talked about it, the information that we provide, it must be relevant and faithfully represented the assets or liability being valued, and provide the best information possible with the cost/benefit. So the cost when we have a cost and we want the benefit to be higher than the cost when we are looking at the information. Now the word here is value in use measurement. This is for sometimes we use value in use measurement for the assets. When we're impairing an asset at the end of the year, we use value in use. This is entity specific measures based on the entity's plan for using the assets, not the market participant view. So this is entity means within the company you do this. Used when value in use measurement is used when you determine the asset impairment. So when we think of it, asset is impaired, we look at the value as used, which is the carrying amount. If the carrying amount is greater than the recoverable amount. So there's two amounts that we compare when we think of it, if the asset is impaired or not. We look at the carrying amount and we wanted to compare that to the recoverable amount. So how do we find out the recoverable amount? That leads to our next one. What is recoverable amount? Is greater of the fair value, less the cost of dispose. So anytime you dispose an asset, you have to pay commission. Maybe somebody is in the middle to sell that asset. So what we use is we use the greater amount, greater of the asset's fair value less the cost of disposed value. That becomes your recoverable amount. So then you compare it to the carrying amount, and that, and from there, once you compare it, you look at it if it's if the asset is impaired or not, and then you do the adjustment according to that. Now, sometimes to how do we calculate the value in use? Sometimes it is given to us for some of the assets, carrying value becomes the value in use, and sometimes when we have a future, sometimes we calculate the value in use by estimating the future cash flow, and sometimes we use it when we calculate the present value of these cash flows. So that's another way of calculating the value in use, is by having these two estimates available to us. When we sometimes we have a future cash flow estimates, and we wanted to calculate the present value of those estimates to find the value of value in use, and then what we do it then we do asset impairment in that case. Measuring the fair value, this method is used under the IFRS. Fair value under IFRS is an exit price. Now, exit price is also called a selling price, so it's also a selling price from the company's perspective. Now, fair value can also be measured when we look at the value of potential buyers. So we have an asset and somebody wants to buy that asset. What value that potential buyer wants to pay us? So that is also a fair value of the asset. So that could that's we measure that's according to IFRS, in order to measure fair value of an entity. So now if you're measuring the fair value of the entity, means of the company, the items being measured, how these items would or could be used by the market. And now when we think of an entity, is a company. So if you were to sell that company, what we know, of course, in the company we have some kind of assets, then we look at it, how these items would be or could be used by the market in which the item would be bought. So if we have the items, we could also look at it, how these items would be bought and sold, and then what model is being used to measure the fair value so of these items. So that's just talking about a fair value method. A fair value when you're measuring your assets, or your company. We use a fair value model to measure the assets or the entity. Now, if you're measuring the fair value of an asset, now we're going into the asset. When we look at it, we look at these things. So specific nature of the asset. So who's going to buy it? The nature of the asset, the condition of the asset. Is it very old? Is it damaged, or an absolute? So of course, if it's old, you're not going to get that much value. So that's what it means, is that condition of the asset and the location. If I'm selling something in Brampton, and then I live in Brampton, but if I live in let's say Vaughan, I will be selling items in Vaughan. If I'm living in Toronto, I will be selling item in Toronto. If I live in Toronto and I have an asset that I wanted to sell, if somebody's going to come from far away, they're going to of course the value of the asset will be different at a different province. That's what it means. The location is important, measuring the fair value of the asset. Now, how could then also the other thing we needed to look at it when we are measuring the fair value, how these items could be used or or would be used by the market. So we look at this asset, and then when we're valuing them, we wanted to know how this asset the best is going to be used. So these are some of the when we're valuing the item, that's what we look at, it value based on the highest or the best use regardless of how it's currently being used. Now we also can, when we're measuring the fair value, we can also look at the market. The value of the asset can be based on the market the entity is in, the principal market. So, and then the other way of measuring the asset at a asset will be the valuation technique model. That is more accurate. The most accurate is the liquid market. So the valuation is always technique model is the most accurate, is the liquid market. Models introduce estimates and measures uncertainty. Models requires, of course, when you're using different type of models, they're not always going to be 100%. So it depends on what type of information that we have it available. From there, we can decide which model is a better model for that specific asset that we are measuring. This is where we are going to be using our calculator present value concept. So present value concept, we're going to be using it in this class, and then we're also going to be using in chapter 9, and we're also going to be using that when we complete our when you do your second reporting, that you're going to be doing it in your second course, where you're going to be using your leases. You calculated the leases at the present value, and we also use our bonds. Bonds are recorded at the present value if they're investments. So we're going to be using present value calculations a lot. Now, the value of what is a present value? The value of $1 today is not equal to the value of $1 in the future. Money, we always think of a money today can be, if somebody's going to pay you in the future, you want that money today, because the money you invest today, that can earn interest, and over time there's more risk involved in the investment the higher the interest. So of course, if you got the money today, you invest that money, and that in money if you invest in, if you want a higher return, you have to, if you want a higher return, of course the risk is going to be higher. If you want a lower return, the risk will be lower. The three fundamental principal variables that you need in your present value. Not it's always that you need it, but those are the three fundamental variables that you need. The principal is the amount you borrowed. If you're borrowing money, that's the money you borrowed. If you're investing it, that's the money you're investing into the market. The second is if you borrowed it, of course, you're going to pay the interest to somebody. If you invested it, they're going to pay you the interest. Time is important. How long you're borrowing the money, or how long you're investing the money. So they are important. So if you were to use a simple calculation, simple interest calculation is principal times the interest times the n. So now we're not going to be using this the formulas. Our most important way of calculating present value is using the finance calculators. You guys are in the finance, so that you will be using the finance calculators. So there's a different way of calculating the present value. There's a formulas you could use. You could use the tables. You could be using the spreadsheet, but we are going to be using the calculators in this class. And we're going to be showing you how to use this calculator too. Now, assume you want to invest a sum of money at 5. So we're investing it 5% in order to have $1,000 at the end of 1 year. The amount you will need to invest today is called the present value. So we wanted to know how much we invest today to receive $1,000 in the future. So that's what, when you think it, you wanted to receive, FV stands for future value. That's what you want in the future. How long in 1 year, how long you wanted to, how long you want this $1,000 in, you want it in 1 year from today, and the interest rate that you want is a 5%. So you want to know how much we should pay, how much we should invest today in order to get $1,000 in 1 year from now at the interest rate of 5%. Then if you put that in your calculator, you put it the way I showed it. You put n equal to n, then you put 1 and then n 5 IY 1000 FV, and you're going to compute your present value. When you're putting in the interest rate, you put it as a number. So put the number first in your calculator and then put what corresponds with that number. 1000 will be FV, 5 will be IY, I will be N, and you're going to compute your present value. When you compute your present value, you should get an answer of 952.38. That means that it will be a negative number. If you're investing it, it will be negative, means that we needed to take out $952.38 from our bank account to invest in order for us to receive $1,000 from 1 year from now. So now they showed you how to use, how you're going to do it using a formula, which you could learn if you want to, but we're not going to be using it. We're not going to be using the table. So in tables, you have to look at the 5% and you look at 1 year. And this is the annuity, the tables that you're going to be looking at it. But then we don't need to, we're not going to be using that those tables. And then the other one, this is the one that we are going to be using, is a financial calculator. I showed you how to use it, but this is another way of looking at a future value. FOV stands for future value, N stands for number of periods, IY stands for on your calculator interest rate, and you're going to compute. When you say compute present value. And with some companies, they use spreadsheets. We don't need to use spreadsheets, because the reason why we don't use spreadsheet is when you're writing a test and you're writing it, you're not doing it on the computer. There's no Excel. Now, just going further with the present value concept, example, present value of series of future cash flows. Sometimes when you have a series of payments, then what it becomes, on your calculator, it becomes a payment. So like what we did before, if it's a lump sum, then it's a present value. If you're putting money today, then it's a present value. If you want something in future, it's a future value, but it's a lump sum payments. If you have an equal payments or series of payments, then it on your calculator, that is called a payment. So assume you pay. So what we're doing is we're paying it. Just the word here is a pay. You can put it in as 1,000 annually for 3 years. So N is your 3, your IY, which is your interest rate, is 4. And then what we needed to do is we want to know how much we should have today, and what we're doing is we're computing your present value, and that should come up with a 2775. And this is, we want to know how much should we have today in order to get an annual pay $1,000 annually for 4 years. So assume you will pay, so if you borrow, in other words, if you borrowed 275,000 today, what you're doing is you're making it a 3 annual payments. In this case, that's where the 3 comes. If you're making 3 annual payments in your calculator, those are a sequence of payments or series of payments, and you wanted to calculate the present value of those annual payments. Now this is another way of looking at it, doing the tables. And this is what I was talking about, a table. When you have a table, what you're looking for is whatever your interest rate is. In this case, our interest rate is 4%. From there, we're looking at it, how much are we getting each year. So this is where they're getting. So just to show you a little bit, if you look at it, the first year you got received an annual payment. When you're present valuing that, you will use this number. And the second year you will be using this this number. So, and then year 2, this is not the this is the annuity table. In this case, when you have an annuity table, I didn't see it, it's not a there's 2 type of table there. This is the present value of an annuity table. When you have an annuity table, all you're looking for is this these payments you're making an equal payments. You only look at it for each year, so it will give you a same answer. You have to look at each payment. So when you're looking at the annuity table, how many payments we're going to receive it, we're going to receive 3 payments. Then all you look at it, what is your interest. In that case, the interest is 4%, and you look at 2.775. So this is if you're looking at the annuity table. But if you're looking at the normal present value table, then you have to look at for each year. So I didn't see it before. This is an annuity table. So when you're looking at the annuity table, you only look at if the payments are same. Then what you're going to do is you're going to look at the annuity table. If the payments are not same, then you have to look at the normal present value table. In this case, I don't think the PowerPoint has a normal present value table, but we're not going to be using the the tables. What we're going to use is this is going to be our best friend. We are going to be using our finance calculator to calculate any present values from this point. Going further, sometimes what happens is when we're using the present value tables, or when we're using our calculator, when we're given a rate, that rate, how do we convert that rate in the annual rate into a compounding periods? In other words, if you're if your annual rate is 6% and the payments are made to you semi-annually, then all you're going to do is the annual rate, how many payments in a year, you're going to receive 2 payments in a year, and then you're going to put 3% into your calculation when you're calculating if the payments are semi-annually. If the payments are monthly, you take the annual rate divided by your months, how many months in a year, and that will give you 0.5 for the interest rate. So the rate we are normally given unless it's stated their annual rate. So what we wanted to do is we want to match that annual rate from to the frequency of our payments. If the frequency of our payments is semi-annual, we convert that rate into annual to semi-annual. If it's our payments are monthly, then we convert that rate into monthly frequencies. Sometimes it is when why we don't use the tables. So if you look at the tables, they are there's no between number. So either you have 2 or 3, 4, 5, 6, 7, but there's no any numbers in between. So what happens, it becomes really hard to use the tables if your interest rate is 5.25 or 5.45 or 5.35. So that's why it is important to use the calculator, because then your numbers can be precise. Now going further, when we're doing the measurement of fair value, IFRS has a different way of measuring the measuring of the elements, and ASPE has a different. So what ASPE does is ASPE uses a CPA handbook, and it uses a part 2 of section 1000, where IFRS what they uses is IFRS 13. That's where most of the guidance is available to the public companies on how to measure the measurement of a fair value of your assets. So that's it for chapter 3. Measurement. We have a measurement of our asset of our financial statement elements. Or my next recording I will do it is for the questions at the back of the chapter. So thank you so much for listening to me, and I will see you in class. If you have any questions, send me a message, or post a message on to my YouTube message, and then I will reply to the message. Thank you for listening to me.